Good morning. Welcome to Stock Market Today. It's Friday, September 25th, 2020, and this is your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. You can find me, as always, on Twitter at DanRusso_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for a free email where I get a lot of the content for this show. Also give you daily stock ideas to consider. It hits your inbox every trading day before the market opens. So U.S. equities finished higher Thursday in a choppy session. Leadership was in a pretty diverse group: utilities, staples, tech, and materials. Healthcare and energy lagged. Those are two groups that we've been talking about being weak of late. Not really for energy, weak for a while. Treasuries were unchanged to stronger at the long end of the curve. The dollar was flat. Gold finished up 50 basis points after falling more than 2% on Wednesday as real yields move higher. WTI crude settled up 1% on the day. As we get to the desk this morning and kick off Friday, S&P futures are down 50 basis points with stocks on track for their first 4-week losing streak in over a year. Asian markets were mostly higher overnight. European markets are weaker here this morning. Treasuries are a little changed. The dollar is bid against the euro and yen. It's on track for big gain this week. And I think arguably the dollar right now is the most important chart in the market. Gold is off 70 basis points with that dollar strength. WTI crude is down 30 basis points to get us going on a Friday morning that starts with SPY continuing to test the key support zone near 325. Now, we've been highlighting this zone. Remember what we said. We lay out the roadmap. Above 340, all systems go. Below 340, we're targeting 325. We hit 325. Now we're looking for signs of stabilization. Earlier this week, we said it might make sense to begin to deploy capital, especially for investors with a longer term view. And now, as we sit here, if you've deployed that capital, now you give it some time to play out. Okay, it's not jump all in, jump all out. It's assess the odds, deploy a little bit of capital, and see what happens. To me, I know that I added to some quality names on this pullback, maybe put about 10% of my capital that I had back to work this week. And now I'll wait it out and see how it plays out, looking for signs of stabilization with the realization that a break here through this support zone likely targets 300 to 305 to the downside. Qs, well, they're so far are failing to retake that key 270 level, and I think that that's really important. And then IWM is showing the most weakness of late. We want to see this group in gear with the broader averages on the upside. That's one of the things that we've been talking about. They don't have to lead. They don't have to be outperforming SPY. They don't have to be outperforming Qs. But just strictly from a breadth perspective, we would like to see small caps working with the rest of the market. All right. If you think about what that means, it would be a broadening of participation, not a broadening of leadership, a broadening of participation. And those are two different things that I think a lot of people get confused sometimes. Okay, if the market wants to go higher and it wants to go higher led by the mega caps, that's fine as long as the small caps and the mid caps are going along for the ride, right? And then it just becomes a stock selection game within a healthy environment, right? You skew to the relative strength. What we don't like to see is SPY going higher led by a small group of names while small caps fail to confirm. That's a lack of participation, and they're different. Leadership, performance, and participation are two different elements, and that's just something to be aware of when you hear people talk about breadth, at least in my opinion. So that's the framework for today. We would love to see SPY hold this level. We would love to see the Qs retake 270, and we'd love to see the IWM get in gear. Ever mindful that the market does not care one bit what we would love to see. That's why your risk management process becomes really important. Let's hit our market in a minute now. What are we writing about in the note today? Well, we tread water yesterday. It was a very choppy session of back and forth trading. Growth over value begins to reassert the trend, and that's something that we highlighted last week as being likely. We'll reevaluate that here today. High yield fading relative to treasuries. That kind of gives you a sense of the type of environment that we're in, right? Especially with, again, connect that dot to small caps being the weak link here of late. And you understand that, it is not a screaming risk on environment. We're searching for signs of stabilization. If you redeployed capital, I think you sit back now and you wait, right? Market regains 325 on the SPY, 270 on the Qs, put more to work. S&P gains 340, Qs continuing to work, put more to work. It's not an all-in, all-out bet. And as I said earlier, I think the dollar may be the most important trend in the market right now. Futures point to a lower open here today. We'll get into the dollar chart a little bit later on in the show. Taking a look at the major indices now from a power bar perspective, the Dow tacked on 19 basis points yesterday, but still has a bearish ratio at 3 to 8, bulls to bears. S&P 500, 88 to 124, bulls to bears there after adding 24 basis points, skewed bearish. NASDAQ now skews bearish. Up 47 basis points, but 13 to 15 bulls to bears. Small caps are the only group that is bullish, barely so at 417 to 370 after a flat performance yesterday. Bonds go bid yesterday, sending yields lower, and one of the leading groups on the day was utilities, right? So that just kind of gives you a sense that even in an up tape, utilities and staples were your leading sectors, right? That's a defensive posture. According to the Chaikin Power Bar, small cap stocks are somewhat more bullish than large cap stocks. Major indexes are mixed. Let's hit our stock of the day now. Stock of the day is really a thematic play on rising agricultural commodity prices and a way to express that view in the equity market. I recognize that a lot of people don't like to play around or look at commodities, don't have the scope, the bandwidth to do it. But I think it's important to be aware of the trends that are playing out and then have an understanding of how you can express that view in a market where maybe you're more comfortable. I think more people feel more comfortable trading in the equity space rather than the commodity space, and that's fine, even though there are commodity ETFs. The theme is a trend towards higher ag prices. You can see it in corn, wheat, soybeans. Now, they may be a little bit extended here in the near term, but I do think that it's a trend that has legs. We've talked about names like Mosaic, MOS. This is another play on that. Archer Daniels, Midland ADM, has a very bullish rating here at Chaikin Analytics. Strong trend. It's in the food products group, which is weak, but thematically, I think this stock makes sense. We have a very bullish stock. Look at the relative strength of late, really seeing an increase in the intensity of outperformance as the stock enters an oversold position. Now, we've pulled back here. There's support in the $42 to $44 range. I think we want to hold that, give the oversold position some time to work itself out, and then presents an opportunity as far as I'm concerned. So Chaikin money flow mostly bullish since the July timeframe, going into a little bit of more of a neutral stance here. So as a thematic way to play trends in commodities, you can look at names like Mosaic, you can look at names like ADM in the equity landscape. So take a look at ADM today. Let's look at our sector tracker now, moving over the last 5 days, still red across the screen. In tech at the top of the list, that's encouraging. Staples is defensive, so that's not as encouraging. Comms round out the top three. Discretionary Utes, healthcare, industrials, and fins are middle of the road, all lower over the past 5 days. REITs, materials, and energy are at the bottom of the list. So the materials trade is interesting because we liked it. But this week, what we've been talking about is, hey, look at this dollar strength. If this continues, we have to reevaluate that view. So certainly less aggressive on the materials trend until we see how the dollar plays out. We'll look at the dollar a little bit later on, as I said, because I think it is the most important chart in the market right now. I really do. No two ways about it. Dollar's been inversely correlated to risk assets over the past 6 months. So as goes the dollar, you have to start to think about what that does to other asset prices. You may not care to trade the dollar, but you need to be aware of it. You need to understand what's happening there because it's impacting the equity market, all right? It's impacting the equity market. It's impacting the commodity market. A lot of people like to look at gold. You think it's a surprise that gold broke trend, broke support as the dollar broke resistance? It's not a surprise. It was there for you to see. As soon as the dollar broke, you knew you probably wanted to be lightening up your gold positions. Let's take a look at our industry in focus now. Transport services. This is actually one we touched on last week in our note. Over the past 6 months, it's been an outperformer by about 15%. Power bar ratio, which looks at future potential, is strong, but barely so. At 10 to 9 bulls to bears, it's currently ranked number 6 of 21 subsectors, moving up 4 slots over the past week. ArcBest, Atlas Air, and FedEx are your names that you want to potentially look at that are holdings of this fund that has pulled back with the market. Rating still bullish, strong trend, strong power bar ratio above the trend line, bullish money flow, oversold here and outperforming. So I do think transports look compelling on a relative basis, but just be mindful, right? Use the roadmap. Under 325 on SPY, odds are higher that we move lower. So if you've put some money to work, you're looking for the stabilization. If we're under 325 now, you're looking for the pockets of relative strength as the market sells off, because that's where you want to be looking for bullish ideas. Let's take a look at what's trending now. Yesterday's S&P 500 movers and shakers, our gainers and losers. Darden reported yesterday, and their EBITDA number beat expectations, stock higher by 8%. Illumina gets a rebound after some heavy selling on the back of their M&A announcement. Goldman Sachs cut an upgrade at UBS. Would also point out that Jefferies had a solid print earlier this week. Goldman higher by 4.8%. FCX caught an upgrade at Morgan Stanley to send that stock higher by 4%. Interesting timing of the upgrade, because actually Morgan Stanley at the strategist level had been bullish early on the materials and cyclical theme. And now their analyst is coming around to upgrade Freeport just as the dollar is breaking out, and that could have a negative impact on commodities. So kind of an interesting call there, something to keep in mind. IVZ, nothing company specific to drive trading there. Loser side of the board, KMX earnings send the stock down 11%. Same with Accenture, earnings send that stock down by 7%. Twitter caught a pullback after 2 days of solid strength, down 4.8%. I am a holder. UAA pulling back. Remember, that stock rallied on the back of the solid Nike print. Under Armour, a bearish stock, now lower by 3.7% yesterday. And Western Digital down 3.5% yesterday after a strong pop the previous day. Let's look at the themes now. Growth over value, reasserting. Here's that chart. You know it well because we show it a lot, because it's been one of our key themes. And justifiably so. That is an uptrend. Long growth over value has gotten you paid. Now we've gone into this consolidation, and it's one of the raging debates in the market right now. Are we shifting? For right now, I think that we pulled back into a support zone, and now we are beginning to move higher, which is what we said was likely to play out when we showed you this chart last week. RSI is holding bullish ranges during the consolidation. That's encouraging. And it's also a benefit for the Qs, which are consolidating relative to the SPYs here. So until this really breaks down in a meaningful way, I find it hard to change my view on the growth over value theme. Keep in mind, though, this is relative. So if the market decides to leg lower, growth value go down together, maybe growth goes down less, which would cause this trend to continue to move higher. So just be aware of how those relative relationships work. But so far, this is still a theme that we like. High yield over treasuries speaks to risk off in the marketplace. Right out of the March lows, solid rally as investors loaded the boat on equities, took a higher risk position, backstopped by the ever-running money printer at the Fed. And now this ratio has rallied all the way back to the declining 200-day moving average. So really what happened here was it got massively oversold to the downside, extremely stretched, snapping back to just kind of return to trend, right? Mean reversion at its finest, and now moving lower. The RSI of this ratio failed to become overbought on the most recent leg higher and is now moving towards bearish ranges. And this is all playing out as the 10-year yield remains pinned to the floor. I think the biggest question right now is which way do rates break? And I think, you know, there's the debate of whether or not we go negative. So far, the Fed has said they don't want to go negative, but it's still a debate that's raging in the market. And then finally, I will end it with what I think is the most important chart in the market right now. Here's the US dollar breaking out of this 2-month consolidation to the top side. Now we do have a resistance zone just overhead in the 95 to 96 area. We've retaken the 50-day, still below the 200-day. RSI moving into bullish ranges, and here's your tell, right? Here's the dollar consolidating and gold consolidating, dollar breakout, gold breakdown. It was there to see. So just be mindful that if you are bullish gold, Right now, the dollar is probably the most important thing that you're paying attention to. That's going to wrap us up for today. Take us for a free test drive, 14-day trial. Head over to chaikinanalytics.com/test drive.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.